then that machine works as long as it can keep growing loans. Then that fair value dynamic works. And then if the public markets value on a price to sales ratio, I don't know if that's appropriate for a bank. You're saying price to tangible book.
I wouldn't use a price to revenue or EV to revenue type multiple. And the main reason for that is if revenue is a bit of a fungible and interesting concept, we talk about financial institution, because if they were making worse quality loans that were subprime and had a higher interest rate, the same amount of loans would generate more revenue. Would you think that's more valuable or less valuable? I would argue less valuable. Revenue is an interesting concept because we're talking about a spread business and a margin business. Lending is one of the only businesses in the world where you sell your product or you originate a loan today and you don't know what your expenses are.
Cash flow, everything comes back to discounted cash flow. I don't think anyone would dispute that. It's just a question of when those cash flows show up and then what's the appropriate discount rate. But the basic idea is like under the treadmill concept, hey, if you originate these loans and you can keep growing the loan origination, you can keep growing revenue. Now, SoFi has curtailed the origination in their most recent quarters. That's number one. So that treadmill has stopped. And number two, we're also seeing for the first time negative fair value adjustments.
I would split that a couple different ways. And I think there are really two topics there. One is a bit complex, and it's, are the fair value marks appropriate or reflective of what the loan should be worth? That's the first topic. And are the estimates that underlie that framework accurate? And are they actually reflective of the price somebody would pay in an arm's length transaction for those loans? And then the next one is, in some ways, revenue recognition and how all that has impacted their financial statements and their reported financial performance. And I think those are two very interesting topics, because one of the things that you've seen, and this is something that we can obviously get into, is that if you look at the personal loan side of the business, as an example, going back, one of the important factors to think about is where you're pricing, what your discount rate is, which is effectively a proxy for the yield that should be generated on the loans if an investor were to purchase the loans at the designated price or the estimated price. The benchmark rate for personal loans is 2-year SOFR. And if you look over the last few years, the spread assumption that's embedded in the discount rate for SoFi's personal loan portfolio has gone from 5.94% at 4Q in the fourth quarter of 2020 all the way down to 1.25% in the first quarter of 24. And there's slight rounding because they report their discount rate to the nearest tenth of a percent, and I'm obviously going to the nearest hundredth.
SOFR, that's the new LIBOR, the new way to think about like risk-free rate, short duration basis that typically banks charge to one another.
It's effectively the risk-free reference rate for those securities. And if you think about a yield asset or a loan, the way you would think of what you would demand for that loan is a spread above that. A secured loan should have a lower spread, whereas an unsecured loan should have a higher spread on a relative basis. We're talking absolutes here. So then if you were to then dig into some of the estimates, what I would say is a fairly big difference is that take two companies that are originating what I would view to be very similar quality loans, Lending Club on one side, they're selling loans and using a discount rate of about 8% for their personal loans, whereas SoFi is using a discount rate of 5.8%, which is substantially lower.
And that's the all-in discount rate.
That's the all-in discount rate, which would be a rough proxy for what an investor should generate based on the estimated prepayment speeds, credit losses, et cetera.
And what are mortgage rates in the United States now? 6% plus.
You're in the high 6% range at the moment.
High 6%, but surely SoFi has a reason for using a lower discount than a mortgage rate, which is fully collateralized by a house. How do you justify a discount rate that's lower than what Fannie Mae or Freddie Mac?
When you take a step back, there's a lot of different indices that we can look at. The rough reference index is 2-year SOFR for personal loans. It's going to be different for different. A mortgage loan is going to be in a different place on the curve just because it has longer duration. And obviously, there's a lot of differences between the implied duration of mortgages. But when you take a little bit of a step back, there is a fairly liquid market in the ABS markets. It took a little bit of a hiatus during COVID and is coming back slowly. But there is a liquid market for asset-backed security or securitizations, and specifically the senior tranches of securitizations, where you're seeing the A notes and sometimes you have an ABC structure. When your A note or your senior paper in those securitizations is usually, call it 70 to 90% leverage on the loans, and those are pricing around 225 basis points above 2-year SOFR at the moment. And there's securities with CUSIPs that trade. If they don't trade daily, they almost trade daily, and they're actively traded and actively priced fairly often by different issuers. So we have a rough sense of what a non-bank would have to borrow at to lever their portfolio to get an acceptable levered return. most of the structured investors, they're looking at these transactions.
So what you're saying is, hey, if you look at the senior bond and a securitization, that means it's protected via subordination, credit enhancement, over collateralization. These are last in line to default, and they are rated. They're rated by Moody's. SoFi's bonds are rated. And those are good bonds, by the way. I got no issue with SoFi's senior bonds.
They're secured and they have credit enhancement because they're lending at less than 100% of the value of the loans.
That's right. Others eat their losses first, and that bond is last in line. So now you're saying, hey, look, SOFR is what, 530 dips today, 5.3%?
So 2-year SOFR is, and if I look at it on my screen, in this very second, it's about 455.
455. Okay, got it. And the senior bond has a spread over SOFR of what, 225 bips?
Roughly speaking, 225 basis points. And I'm making generalizations based on like what's out there in the market. You'd be at roughly 6.8%.
So you get 6.8%. So how is SoFi discounting their personal loan book at a rate far lower than what the capital markets are using to discount the senior bond? And by the way, the senior bond has less risk in the personal loan portfolio, meaning the spread above SOFR on the personal loans, wouldn't that be higher?
I think we're getting into the crux of a few different things here. SoFi has reduced their spread assumptions over time, which has had a significant positive impact to both revenue recognition, profitability, et cetera. That is an interesting topic there around the first quarter results and kind of what I forecast for the year. I think there's an important thing when we're talking about the discount rate. It's a calculated and estimated number as of the end of the period. So this would be as of March 31. But if you were to take it as of today, it would imply that senior paper is probably priced around 6.8%. Different issuers are going to have different specific rates. It's not going to be exactly the same for everyone. Some are better issuers, some are worse. There will be some variation there. So I think the question would be, if you take the current discount rate, it wouldn't make sense for a non-bank buyer of the, let's say SoFi loans in this case, to purchase their loans at the current valuation, 104.24, assuming we're at March 31 here, and then go to market and have to lever those loans with leverage that's effectively 1% higher from a cost perspective, because you'd actually get a negative impact due to your leverage. If you even take that a step further, there's a lot of pushback because take an entity like a lending club that has very similar quality collateral, and I mean, I could actually argue that they've probably actually gone upstream and are probably originating better collateral now, whereas SoFi's probably gone a little bit further downstream in terms of the type of loans and the quality of loans they're originating. They're selling loans close to an 8% unlevered yield. And they're transacting much more often in the market as opposed to one-off negotiated transactions. So that is creating a lot of pushback because when you look at the revenue recognition, that's driving a tremendous amount of additional pull forward for SoFi that's positive. In a sense, they wouldn't have been profitable last quarter had they been using an 8% discount rate.
How much management discretion is used in the determination of the discount rate? Is that not promulgated by FASB or the SEC? Who sets that?
There are obviously FASB rules around fair value and the way it should be recognized. There are nuances. If you look at disclosures, it is a topic that gets a lot of scrutiny from an audit perspective. Almost every company that has loans at fair value has some sort of disclosure about enhanced scrutiny of fair values. You obviously have to have a process in place. You have to back test it. You have to provide some support. Where I think things get a little bit, in a sense, where some people push back on SoFi is that the discount rate seems lower than structurally senior and secured paper that's credit protected on the same assets. And even if you look at their financial reports, and I put out estimates in the past, they provide financing for the purchase of some of their loan sales. And based on my estimates, they're charging around 6.2%.
So if someone buys a SoFi loan, and SoFi's a bank, they've got cheap deposits, they can finance that. They can finance it off their balance sheet, as they should. And they understand the collateral. Why not? But they're charging a higher interest rate to finance SoFi loans, and they discount their own loans on their balance sheet.
If you were to take a step back, in the fourth quarter and in the first quarter, the numbers are roughly similar. They're right around 6.2%, depending on how you calculate, it might be 6.3%. My estimate is that the leverage that they're providing to whole loan buyers themselves as part of some of the whole loan sales that they're doing, they've done both the fourth quarter and the first quarter, is that they're charging roughly 6.2%. There is a mix of both quarters when we look at the first quarter, but the discount rates that they use on the underlying loans in the fourth quarter was 5.5% and 5.8%. So in a sense, if you were to take a step back, what that implies intuitively is that based on their analysis of the loans and their forecasts, they're getting the purchase price reflects that yield. But what it also implies, though, is that the loan buyers, or that if anyone purchased the loans at those prices and had to lever those loans at 6.2%, that they would probably get a negative impact of leverage. They'd actually be better off not taking out leverage.